The Nasdaq was up about 1.7% today, but the reason for this might surprise you. Yes, we did have PPI coming in lighter than expected, which is good news following 2024. Basically, all we get these days is hotter than expected inflation reports. But in fact, what actually caused this rally today was bad news. Yeah, that sounds a little crazy, but it's true. You had a 30-year bond auction today. The last bond auction you had prior to today, the yield came in at 4.331%. The yield today came in at 4.671%. That is a 34 basis point increase since the last 30-year bond auction. And what you can actually see on the markets, this came out at 1 p.m. What happened? You actually did see a down candle on this auction. And then what happened? It got bought up. And this was almost seen as, the bad news is here. It's over with. Go ahead and buy the markets. And that's exactly what proceeded to happen following the early afternoon around 1 p.m. Markets just took off. Now, this was largely based around big tech, with Apple up almost 5% today as a notable name. That is having a huge weighting on the broader markets. But if you take a look at the percent of stocks above their 50-day moving average, yesterday, 12% of stocks fell under their 50-day moving average yesterday. That is a huge number. That's the biggest number I've seen in a very long time. Today, only about 1.5% of stocks are breaking above their 50-day moving average. So although you are seeing this big update, it's mainly concentrated in your big tech names. Only 47.1% of stocks are above their 50-day moving average. Now, this has me asking the question, is this the last kind of blow-off top rally? Screw the shorts, absolutely punish the individuals with puts, and then you see a bigger decline? Well, we have some events coming tomorrow that I will speak about here in this video. But before we go any further, hit the like button, subscribe to the channel if you have not done so already, and you like markets, you trade markets, you invest in markets, and you want to stay up to date with all of your biggest news each and every single day. Now, if you are under the assumption markets are going to fall from here, I think that's a pretty safe, let me stop myself there. Nothing is safe in markets ever, so I don't want to word it like that, but I think odds are markets do fall from here. Minus today, you are in a pretty solid downtrend on the Nasdaq. In the S&P, it's a little bit more obvious with the S&P clearly starting to roll over, but it's been very choppy. It's been back and forth. You haven't seen, consecutive down days that really, take this thing home as far as we're officially in a downturn. We're heading into a correction. That hasn't quite happened yet. Now, you are under your 20-day moving average on the S&P 500, which is this yellow line here. And that's widely seen by markets as a trend-setting level. What happened before is every time you got to your 20-day moving average so far in 2024, you bounced. This time did not happen, although today you fell to the lowest point so far in this little downturn we have seen that's only about, a week and a half, 2 weeks old at this point. You bounced down here at about 512 on the SPY and bounced up above your 20-day moving average. Now, 20-day moving average is currently at 518.16, so you're technically above that by about 45 cents or so. So I'm not going to sit here and say this is confirmation markets are going to go higher now. I don't exactly think that's what is going on, but I do think this could be a last ditch to kind of screw the shorts, screw the bears, screw anyone with some put protection on their portfolio. Now, there's a couple different reasons for this, but I think the simplest way to put it is markets are priced for the best possible scenario. With the S&P earlier today trading at 518, based on the EPS estimates on Wall Street for this year, that means you're trading at about 21 times forward 12-month earnings. You are richly valued, especially considering, the 10-year treasury is now above 4.5%, is sitting at 4.57%. There's not a huge reason to be out there owning stocks today. And you can see 10-year treasury yields are even up about 1 basis point today, almost 1.5 basis points. In the last couple of days, 10-year treasury yields have been exploding higher and markets have not cared. Why is that happening? Why are 10-year treasury yields rocketing higher? Stocks are not falling to the degree that you would expect. Because in all reality, the markets in 2024 could care less about this. It's all about earnings and the expected earnings growth that we are going to see. In fact, you actually started 2024 with the expectation of 11% EPS growth in 2024. Those expectations are now 5%. And stocks have really not re-rated for that at all. Now, that typically happens as you start a new year. Forecasters, analysts, economists, they all have high estimates, and those estimates typically are too high, and they come down as you get deeper into the earnings cycle in a new year. That's common to see estimates fall. But to fall 6%, to cut your estimate in half and not see a reaction in the markets, that's strange. Now, tomorrow is going to be a big event for the markets because you are officially heading into earnings season coming tomorrow. Tomorrow, you will get your big banks that start reporting earnings. You have JP Morgan, you have Wells Fargo, BlackRock, Citi, Progressive, and State Street. Now, I think equally as important as the earnings themselves is going to be the commentary around the consumer. Here's the narrative that everyone on Wall Street is going with. It doesn't matter if the Fed cuts rates, does whatever they want with rates, as long as they're not raising rates. They can hold rates throughout the year, not a problem, because earnings are going to come in, because the economy is chugging along and people are spending money. If the banks come out tomorrow and they say consumers are slowing down, that's a big problem. If they come out and say consumers are still spending like they're drunk, like the last couple of years, we haven't seen much of a change, that's going to reaffirm maybe earnings are going to come in good this earnings season, and guidance is going to be good. Now, if not, again, if they warn about the consumer, then you're going to start to see maybe a little bit more hedging, maybe a little bit of that sell first, ask questions later kind of mentality. Because if earnings don't come in good, there's really no reason for stocks to be this high. Now, at this point, it appears likely to me, even if you come in and you meet estimates, that's not going to be good enough because of how expensive markets are. And I think earnings are going to be the big catalyst. Now, I will point out here as markets are closing, you actually closed under your 20-day moving average. 20-day moving average by the end of the day today hit $5.18. $518.13. The S&P closed at exactly $518. You're down in after hours, down to about $517.88. So in fact, you did not close above your 20-day moving average today. If that serves as resistance, again, that's problematic. Now, you are seeing to some degree fear heading into tomorrow morning's earnings. You can see here that the MOC imbalance, this stands for the market on close imbalance, is 2.1 billion to the sell side today. Okay, so that means the last 10 minutes or so, there were quite a few positions, to say the least, that were trying to get sold heading into tomorrow. Now, $2.1 billion, it's not the highest we've ever seen, but that's definitely in the top like 90% of market on close imbalances to the negative side. Okay, so that's not a great sign heading into tomorrow, and likely means you're seeing some more selling here in after hours. So it appears like the way we're set up right now is inflation has been bad, all bad. PPI came in a little bit better than estimates today, but really, markets did not go higher on that today. Markets went higher on bad news. Whenever that happens, that's not a good sign. PPI month over month on the headline came in lighter than expected at 0.2%. Estimates were 0.3% on average. Core PPI came in right on estimates at 0.2% month over month. Initial jobless claims were revised up a little bit from last week. Maybe that's having something to do with the markets doing well today. It does look like Core PPI year over year was revised up as well, from 2% last month to 2.1%. Year over year, PPI came in at 2.4%, so that was higher than estimates. That's not what moved stocks, okay? I want to be very clear because I know some people are going to say PPI is the reason why stocks were doing so well today. No, the NASDAQ was only up 0.5%. After PPI, heading into 1 p.m. It was all about that bad 30-year bond auction that was seen as maybe this is as bad as it's going to get. Maybe this is the trough. Maybe yields fall from here, so we should buy stocks. I'm not exactly sure the reasoning, but overall, here's how you're set up. You're set up heading into earnings season with super high expectations, super high valuations, bad news on the inflation front, the Fed going from 6 rate cuts at the start of the year down to what looks like 2 now in the first cut starting in September. And you also have some massive geopolitical tensions. The Israeli defense minister just said about 20 minutes ago, a direct Iranian attack will require an appropriate Israeli response against Iran. Now, some news outlets have reported some kind of attack is imminent from Iran. Iran says that they won't be hasty to launch an attack, so nobody really knows when this could happen. Something's going to happen. We don't know when. That's likely going to have an upside, force on oil. It's likely going to drive up oil cost, and that's going to be negative for inflation. That's going to drive up inflationary pressures, and I think that is also something you should be watching closely if you are trading, especially in our markets, because any day, any minute, that news could come out and likely cause a drop for stocks also. But I really do think heading into earnings, you are set up for disaster. You're based on a pure risk to reward standpoint, the risk is that earnings come in not as good as expected. Even if earnings come in right on expectations, it's probably not going to be seen as good news because you're already trading at super high valuations. With all of the other backdrops that I'm talking about here, Middle East situation, 10-year treasury yields that are rocketing, part of that, most of that probably down to Fed policy and where inflation is coming out. With those backdrops, I don't see a good setup here for the markets for the next couple of months, really. I mean, this is an election year, so if stocks were to fall, that might, cause rate cuts to come sooner. Who knows? Somebody's going to try to save the day. But I do think you are, to be quite frank, overdue for a large correction. And I think at this point, that's what is coming. Now, tomorrow you're going to have some economic data coming out as well. And this is important to point out. You are going to get your Michigan consumer sentiment numbers. You're expecting a downtick from 79.4 to 79. So a little bit less on that consumer sentiment number. You want to watch your 1-year and 5-year inflation expectations. 5-year inflation expectations expected to stay at about 2.8%, the same as what you've seen last month. And your 1-year inflation expectations are actually expected to rise from 2.8 to 2.9%. If those rise more than expected, that's obviously bad news. You can start to make the argument inflation and expectations are becoming unanchored if that were to happen. Michigan consumer expectations will also be a big number to watch because that could imply more or less spending by consumers, which is really the main thesis of our markets right now, right? Again, big money's like, hey, people are going to spend money, drive earnings growth. 2024 is going to be a good year for S&P 500 earnings. I don't know if that's going to happen, okay? You want to watch to see if it does happen. If there's signs the consumer is pulling back, that's problematic. And I think that's why the banks could be a bigger deal than normal coming tomorrow because, typically the banks, they're important, but they're not the end all be all for earnings. But they do tell you a lot about the consumer. Now, I find this at a very interesting moment in time because that's the only thing holding markets together right now is the narrative that people are going to continue to spend money. You don't have inflation falling. You don't have the Fed that's in a rush to cut rates. You don't have a 10-year yield that is falling to support markets. You have geopolitical tensions. Like, there's no other reason why stocks would do well if consumers start to pull back. So I think that is the biggest danger right now, and that's the number one thing that I am looking for. And if you are someone that trades our markets, you've been waiting for puts for a while, like probably, most of you guys watching this video, or a good portion of you guys watching this video, that's what it comes down to. Consumers slowing down or not, and the banks could tell us just that, and that is a possibility. Now, coming out tomorrow at 1:30 p.m., you are going to hear from Fed Bostic, and then at 3:30 p.m., you will hear from Fed Daily as well. They are both, to my knowledge, voting members of the FOMC, so what they say could also hold a lot more weight. Now, I've been very clear on this before, and I'll be very clear again here in this video. I do believe a 7 to 10% correction is coming for our market. So if you're judging the correction based on the prior high, a 7% move lower would put you right at about your 100-day moving average for the SPY at about 487. Now, if you were to take that a step further, fall 10%, which honestly, you could fall more than that if the consumer falls out of bed and they stop spending money. So keep that on your radar. But a 10% move lower from the highs would be down to about 472.30 on the S&P. So far, you have only fallen about 1.28%. So there could be a lot more room to fall. And I'm expecting something similar on the NASDAQ. Maybe it could be a little bit more extreme. Maybe you're looking at 10 to 12% on the NASDAQ. But same kind of thing, applies there to the S&P. Hit the like button, subscribe to the channel. Let me know what you think about this information down below in the comments section. Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.